in chapter 8 and then walk through a couple of. So a few things just to remember for these problems. The structure. So it benefits you to follow this structure. Now, what we're going to do in chapter 8 is a much more simplified structure. When we get into chapter 9, it builds out that structure a little bit more. Okay? So, chapter 8 has this problem. We have cash flows of $800 for 6 years, an investment of $3,000, and then we lay it out like this. And we calculate the NPV, the internal rate of return, and the payback. Okay, so when these are nice problems to remind you of kind of how the typical NPV project works and how to set it up. So generally, anything that you see as a one-time investment should go in year 0. Anything that you see as recurring is going to be in these out years. And I'm going to hide this row for the moment. So you should have a line that is the net of the cash flows. Cash flow in, cash flow out. And then each of those, you're going to calculate the present value. So the discounted cash flow, what that means is the present value of the cash flow. And then the NPV is the sum of all of the years. All of the years. If it's greater than 0, it means that that's a good project. And then we have the two other financial considerations that we can look at to evaluate the investment. So the first one is equals IRR, which is the internal rate of return. The other is the payback. So when you're doing internal rate of return, there's no fancy equations to remember. It's just the formula, equals IRR. The difference between internal rate of return and NPV. What is the difference when we determine which cash flows to use? Which cash flows do we use for NPV? We use the discounted ones. For IRR, which cash flows do we use? The undiscounted ones, or the whole ones, or the regular ones, or however you want to describe it. So when you go back and you look at your formulas, if it's the same rows that you're using, that's an error. So the internal rate of return and the NPV calculation should be using different cash flows. And then the payback should also be using the net, or the undiscounted. And in order to do the payback, we basically figure out at what year does the project essentially break even. Okay, so this is a nice, simple illustration. Okay, for these problems, by the way, you guys are being given the discount rate. As a note, when we get to chapter 12, one of the reasons that we're studying that area is that we're going to learn how to calculate that discount rate. Okay. Okay, number 11. So, same kind of setup, right? So, one of the things that I want to make sure we can do is translate the number that's in the problem, right? So when you guys are reading the problem, it says something like initial outlay, right, of $20,000. So when you see something like that, you're interpreting it as this is probably going to be the year 0 investment, right? And then because it says it's an outlay, that means that it's negative. The cash flow is a negative value. The second part of it then says it's going to increase their cash flow by $4,000 a year. So we're going to increase our cash flow. It's going to be $4,000 per year. It's going to take 8 years. So this project's going to benefit us for 8 years. And then we want to know, is it good at a rate of return and 2 different interest rates. So the first one is 9%, the other is 14%. So we can set it up to do that. So the number of years tells you you're going to have 8 periods plus the year 0. The initial cash flow out, or the initial investment, or the initial outlay, $20,000. And then we're going to net those together to get the net cash flow by year. And then we're going to take the present value of each of those, that's the green value, and calculate the NPV. So it's a positive value. And the top one uses 9% as a discount rate. The below uses the 14%. And there's obviously a difference. So why is the project at 14%, discount rate of 14%? Why would it be negative? What's happened to that discount rate? What's the other comparative value? Say again, Hayden?
Well, the discount rate went up, so
yep.
each year the present value is going to be less. So.
That's exactly right. As the discount rate rises, the present values shrink. What is the discount rate in excess of? Yep, so the discount rate is 14. What's the ceiling number to make this project? Exactly. So when you think about this project, $11.81 is the maximum, because that's where the NPV equals 0. So we can use a discount rate all the way up to 11.81. So at 9%, all of these, all the way up to this ceiling, these are good to go. Once we get above 11.81, we would not be able to do the project. Essentially, the project's returns aren't sufficient enough to make this project profitable for our business. So the latter part of the question asks, how high can the discount rate be before you would reject the project? It would have to be higher than 11.81%. And I can actually test that. So at 11.8%, my NPV is $10. At 11.81%, my NPV is $3. At 11.82%, now my NPV is negative. And it's all because the higher that discount rate goes, it decreases the present value. And the smaller the present value, the harder it is to make up for that $20,000 investment. Okay? So if on the quiz you had any challenges with the Chapter 8 problems, go back and review them. Okay. Before I wrap up the quiz, any questions when you guys were working those? Okay. So let's look at a couple of the, want to do a couple of the homework problems. Maybe do one from chapter 8, and then I'm going to do one or two from chapter 9. Okay, so I had a number of questions about these problems. So I'm going to talk about number 23. Okay, so the question tells us we're going to insulate our office for $10,000 a year. So we're going to put, I don't know, we're going to put insulation around so that the windows don't let cold air in and warm air out. And we think that by doing so, we can save $1,000. Then it says the savings are going to last forever. Okay, so forever is a very particular financial concept. What does forever allow us to use in terms of a calculation to figure out the value of something forever? It's a perpetuity. Okay, this is a concept we talked about in chapter 5. So, perpetuity, to calculate the present value of a perpetuity, because remember, we can't calculate the future value of a perpetuity. Because if the dollars go on forever, I don't know how many of them there are forever, so that concept doesn't apply. But I can calculate the present value of a perpetuity. So that equation is cash flow divided by R minus G, where R is the rate and G is the growth. Now, if you are not given G, then it equals 0. It's pretty simple. So whatever the interest rate is will end up being the denominator. Okay, so now we have a project where we're going to expend $10,000 and we're going to save $1,000 per year forever. How do we set this up? Normally, we would take the number of years, and we'd have year 0, and then we'd have year 1, year 2, year 3, etc. Right? Well, we don't have a fixed number of years. That only works if we have a fixed number of years. We have, instead, a time period known as forever. These guys don't work. So I can still value forever. I just don't do it year by year. I use the perpetuity. Okay, so I have my cash flow in and I have my cash flow out, and then I'm going to have my net cash flow, like so, and I'm just going to have the two calculations, the two columns. So in year 0, what do I include? What number goes where? Correct. And is that a positive value or a negative value, Nolan? Negative. It's a negative. 10,000. Then, what goes in the forever column? 1,000. And is it positive or negative? Positive. Okay, brilliant. Now I'm just going to add the in and the out together to get the raw values of the net, or the total values. Okay, so now I have the net cash flows. These are in their total value. Now what I need is the present value of the cash flow. So this problem makes this pretty easy. You can calculate the present value of year 0, or you can just know that the present value of year 0 is that value. So I make it equals. And it's just that value. I can actually do the calculation using the PV function if I want to, but I also know that the present value of anything in today's terms is itself. Okay, now I have this perpetuity thing. So I need to calculate the present value of the $1,000 perpetuity. So I can use my equation up there. So my key item that I need is the rate. So we're going to do two different scenarios. One where the rate is 8%, and we'll do a second scenario where the rate goes to 10%. So here I'm going to use that formula. So I'm going to do equals the cash flow. I'm going to select the cell where the net cash flow is, and I'm going to divide it by the rate. And I don't have a G, I don't have growth, so it's just going to be that number. And that gives me the present value of the perpetuity. 12,500. And then I'll do the net cash flow. And I'm going to add those two numbers together. So 10,000 plus 12,500. So 2,500. Does this make sense? Somewhat, right? So there's two different things that we can do to figure out the NPV of something. We can do it by year. So if you have a project with a fixed number of years, you can do it by year. But in this case, let's just assume that North Park is going to be in this location into infinity. As long as the world is here, North Park's going to be here. So if we went out and we did some work on the exterior of the building and we spent 10 grand, we would pay ComEd $1,000 less every year. And we would say that the NPV of that project is $2,500. Seems like a reasonably good project. Okay? And then if I wanted to do this for the other discount rate, I just copy the whole thing and I just change the rate to 10%. That's tricky because now it's 0. So at 10%, it's an okay project. And basically, the IRR would probably be something like 10.1. I can guess at it because the minute I put in some number greater than 10%, it's negative. Okay? So one of the reasons why we do these problems, it's somewhat to show you guys how you can link together the different concepts. Right? Not everything is a one way, right? You're getting these constructs, you're getting frameworks, you're getting tools. So, if I'm going to build a birdhouse, I need, a hammer and some wood and some sandpaper and maybe some glue and a couple of screws and a level because I want my birdhouse to sit a certain way. There's no one way to make the birdhouse. I just know that I'm going to make a birdhouse. And some birdhouses are round. Some of them are square. Right? So a round birdhouse is going to use different tools than a square birdhouse. Right? That you guys are learning certain tools and frameworks, and you may have to deploy them in different ways. I want to do this problem from chapter 9. So let's look at 9-11. And actually, before I do that, let me highlight a couple things. So those of you that have your book, on page 283 of your book, there's an example. It's called Blooper Industry. Then on page 288 is the solution. The solution is a little convoluted because it uses some advanced Excel techniques. So this is a much more comprehensive NPV evaluation. And it's one of the things that if you guys really want to take some time and work on a few of these problems, this is a great example because it gives you all the answers and then it gives you the solution on how to get there. We just did some really simple problems from chapter 8 that have cash flow in and cash flow out. Well, businesses are much more complicated. Businesses are complicated, right? Businesses have assets and people and IT costs and a lot more things. So those simple examples that we did in chapter 8, they lay out the baby steps for us. But when we look at a project, we're going to have to get into much more detail, right? Let's go back to my example of the lemonade stand. So I want to expand my lemonade empire. My sons, Max and Chase, have the Max and Chase lemonade. And we have decided that we're going to construct a nice, new, beautiful lemonade cart. It's going to have an umbrella. It's going to have some extra electricity because they want to make lemonade smoothies, all that stuff. And when we undertake this project to see if we're going to make money on it, if it makes sense, we're going to have a set of things that are going to occur in the project. So to buy this new lemonade cart, that's a fixed asset, right? It's a table with some stuff. And that's going to cost us $10,000. That's the initial outlay, right? We've gotten some estimates. We figured out how much it's going to cost. So that is an investment in a fixed asset. Remember that fixed assets we can also depreciate, right? So as we undertake these projects, what we're trying to do is understand the economic reality. So I buy a fixed asset. I will also depreciate it. So I have to take those two things into consideration in my analysis. Once we get our lemonade stand up and running, we're going to sell lemonade and lemonade slushies and lemonade smoothies, whatever, right? So I'm going to have revenue, right? So I would estimate my revenue by figuring out how many drinks times some kind of price per drink. And that'll make up my revenue. Also, in order to sell lemonade, I have expenses. So I have to buy lemons, I might have to buy water. I might need some sugar. Right? I have to have cups and straws and all the different things that it takes. I also, Max and Chase might need some help to make their lemonade. So we might have to hire an employee. We might also want to do some marketing. Maybe we want to do some Google ads, right? Maybe we want to buy some, social media, one of those like cool social media stars, pay them to drink our lemonade, right? So there's expenses. This project isn't going to get off the ground if we don't incur those expenses. These expenses are ongoing, right? This is a one-time. But the revenues and the expenses are ongoing, as is the depreciation. It's going to occur every year. Okay? So I have, estimated the life of our lemonade project to be about 6 more years, because at that point in time, Max and Chase will be involved in like travel baseball or travel soccer. They will be way too busy to be operating their lemonade stand. So it's only going to last for 6 years. What will happen then in year 6, that physical asset, I can sell it. I can sell the cart. So I can take it to the, flea market or the auction, the lemonade cart auction, and I can sell it off. So back up here in the fixed assets, in the last year of the project, I can reflect the sale of that cart. Okay, and then the last thing that we have in here is this category called working capital. So working capital, if you remember, current assets minus current liabilities. So in order to start our kind of new lemonade cart business, I have to go out and I have to get some inventory. So I got to buy my lemons, I got to buy the cups, and that is a buildup of working capital. So in the first year of the project, in that initial stage, I'm gonna have to use some of my cash to purchase inventory. And then every year, I'm going to be assessing what my working capital needs are. And as my business grows, I need more and more working capital. Until the very last year of the project, and then what happens is I stop buying inventory. I basically have kind of a rundown of all the cups, all the straws, all the napkins. I don't buy a ton more stuff. So I have to consider this. So for each of these 3 sections, I can evaluate the cash flow coming from that particular area of the business. So the fixed assets is pretty easy. I got my cart, and I buy my cart, and then I sell the cart 6 years later. And it is the pure cash flow associated with that, because I write a check for the cart, and then in year 6, somebody writes me a check at the flea market. That's pretty easy. The operating cash flow, what I do here to line 24, is I calculate the income statement for the lemonade business. So I take the revenue, just a simple income statement. Revenue minus expenses minus depreciation. It's going to give me what it says here is pre-tax profit. And then I have to pay tax. So now I just have profit that's after tax. Okay? This to right here is an income statement. And by the way, when you guys are doing this, don't forget the tax. A lot of people leave out the tax. That's cool. And that gets us 90% there. Now what we need to do is we need to convert that pre-tax or that after-tax profit into the cash flow. So now what we do is we add back the depreciation. This number. Because depreciation is not a cash expense. And this gives me what we call the operating cash flow. Okay? And we call it operating cash flow because it has to do with the day-to-day operation of the lemonade stand. And then we have that last piece, which is the working capital. So what I do is I estimate each year how much working capital I need. And a good financial analyst will do this in a couple of ways. I could do it as a percent of sales. I could do it based on some other metric. But I'm going to estimate this row 28, essentially what is the amount of working capital that I need each year. Then what happens is I calculate the change in working capital. So change, and I want you guys to all write this down on a piece of paper. If you're not writing this down, if you've got this right on the last exams, you're golden. But several people did not. Change this year less last year. This is how we do a change. This year minus last year. Okay, now if I want to know the percent change, then I divide by last year. But in this case, I only want the total value. So this year is $1,500. Last year was $0. So the change is $1,500. This year is $4,075. Last year was $1,500. So that means the change is $2,575. This year is $4,279. Last year, $4,075. So it's $204. Etc., etc., etc. So if this year is a bigger number than last year, that change is going to be positive. Now, this is where the financial component of this analysis comes into play. If I look at the working capital, how much working capital do we need? Now I calculate the opposite way. So essentially what I do is I reverse the sign. So if my working capital increased $1,500, that means I spent $1,500. If my working capital went up $2,575, that's an outflow of $2,575. If it went up $204, then it's a negative. So when the change is positive, that's the way to think about it. When the change is going up, cash flow is going down. So take the change and multiply times -1 for the cash flow from working capital. So first calculate the change, and then take that number times -1. And that will give you the cash flow from the change in working capital. And cash flow can be positive or negative. When it's positive, that means money's going in your wallet. When it's negative, that means money's coming out of your wallet. This section is often a little bit tricky. Okay, now we have three different numbers. We have cash flow from our fixed assets, operating cash flow, and cash flow from working capital. This line, total project cash flow, adds those three things together. So now, for my lemonade stand, I know for each year from year 0 to year 6 what my total cash flow is. And in a way, the other way for me to think about this is, what is my checkbook going to look like? I know to get this business started, I'm going to need $11,500 to get this project up and running. And then next year, I should be able to net put $1,300.75 into my wallet, and so on and so forth. Right? So this whole thing is visualizing the financial and the economic activity of a project. And I gave you guys the example of a lemonade stand. This could be anything. Right? Maybe this is a new service that our company is going to offer. Right? Maybe this is our nonprofit and we want to do an event fundraiser, and then we think that our donations could increase over a series of years. And we could maybe add a person to our staff from that. Like, there's a wide range of applications of this. When we get down into this last set, 32 through 36, this is exactly what we did in Chapter 8. We take the total project cash flows, which is the net of those three numbers. We determine the present value of them, and then we add them together to get the NPV. Right? So this section is exactly what we did in Chapter 8. What happens in these other three sections is we just blew up the details of the cash flow in versus the cash flow out. And we're breaking it down into greater specificity about the nature of those cash flows. What kinds of business activities? Okay, so why I think this is a great problem to work is, one, it's a very nice template that you could use over and over. It gives you the answer. And then back here on page 288, it gives you the formulas. Okay? And also, by the way, if you're someone who is building your Excel skills, this is a great thing to reference because it tells you exactly what to do. The only place that I don't love this example, and I wish that they weren't doing this, but for some of you, this is a really advanced Excel skill. What they've done is they've used this tool in Excel called range name or naming. And what you can do is you can name a field. You can give it an actual name instead of a cell number. So when they say equals investment, what you have to do is look at what name investment is, and what it's doing is it's actually referencing this cell. I would never do that. I don't like doing it. It's too complicated. I like to keep it simple. So I would actually have my formula built up where this would say equals B2, because that's where the investment value is. Okay, so anytime you see words, you actually want to find that cell reference in column B. So kind of look it up in column C, and then come over to column B. So you guys could actually recreate this entire spreadsheet, which could be a handy thing to do, say, for example, for an exam that we might have. Because maybe you might, instead of having a page of notes, be able to submit a template to do the exam problems. I'm just saying, maybe. Possibility. Okay? But if we were doing this in business, in practice, you would be doing it at that scale, not sort of the simple scale that Chapter 8 represents. Chapter 8 is kind of the, like I said, the sort of baby steps. And then Chapter 9 gives you sort of the sprint speed look at it. Okay? Okay, so I want to walk through one of the Chapter 9 problems, number 11. Take my book back. And just see this in practice. Okay. So this problem, we are given some information about their cash flows. And year 1, year 2, year 3, year 4, and then thereafter. We're told that expenses are expected to be 40% of revenue. And then the working capital required each year is expected to be 20% of revenue. But revenues in the following year. So there's some details there that are given to you for a particular reason. The project is going to require an immediate investment of $45,000 in plant and equipment. Okay, so what I would do to set this up is something like this. What I have highlighted here. So, across the top, I would enter the numerical values 0, 1, 2, 3, 4, because we're given 4 cash flows. And then I'd have a 5th column, or 6th column, I guess, for thereafter, just in case. Then it gives me the revenue numbers. I don't have to calculate it. They're given to me. I would lay out the revenue. 40,000 in year 1, 20,000 or 30,000 in year 2, 20,000 in year 3, 10,000 in year 4. That's given to us in the problem. And I enter them all as positive values. Okay, what I have here is kind of a summary, right? This isn't the full-on analysis. I'll come to that momentarily. Now I'm going to do the expenses. So it tells me that expenses are expected to be 40% of revenue. So what I would do is I would take revenue each year and multiply it by 40%. That number right there, 40%. So I have a formula. 40% times $40,000 gives me 16. And then I have that same formula. 40% times $30,000. I do that for all 4 years. So this gives me each year, years 1 through 4, the expenses. So I have that piece handled. And then I need to handle this working capital. So again, it says, working capital required each year is expected to be 20% of the revenues in the following year. So that tells me that today I'm going to have working capital that's 20% of next year's revenue. Okay. So I have my line that says working capital. I have the 20%. And I'm going to go to today first. Because the working capital required today is 20% of next year's revenue. So 20% of next year's revenue is the 40,000. So I take 20,000 or 20% times the 40,000 of revenue. So it's angled. this year's working capital based on next year's revenue. And then when I do year 1, I'm going to use the year 2 revenue. So the 20% of year 2's revenue. And I do that. So in year 4, because my project ends, I have no working capital. Because I don't have next year's revenue. So it's 0. So the final thing then that I have is the initial investment of $45,000. Okay. So what I've done here, by the way, this is something I call a subschedule. So I have my larger analysis that I'm ultimately going to get to, but I've done this kind of mini analysis within the bigger analysis. Because I don't like to guess at things. That's the great thing about spreadsheets. There's plenty of space to do this stuff. So no shortcuts. So part A asks, what is the initial investment in the product? Don't forget working capital. So the initial investment, when you see something that says initial investment or initial, I can't type, outlay, something like that, essentially that means the year 0 amount. That's what you're trying to find. What are we going to spend in year 0? Okay. Well, I have 2 things. One, I have the working capital. And number 2, I have the initial investment in the plant and equipment, property, plant, and equipment. So the 2 of those things together is $53,000. Okay? So I've done all that analysis to help me answer part A, but it's also going to help me when I get into part B. Okay, so part B, we want to know the project cash flows in each year. And it gives us some information about the depreciation. So what I can do now is I can lay out that bigger analysis just like what we looked at. Get rid of this. Hello. Okay. So now what I'm going to do is I'm going to go through each of my 3 sections. I'm going to do the fixed assets first, I'm going to do the operations, and then I'm going to do the working capital. So, the fixed assets. I know that I have an initial investment in year 0 of $45,000. I'm going to enter that as a negative value because I have to write the check for that equipment. And it doesn't sound like I'm going to sell that piece of equipment at the end of its life. So sometimes I might have a sale, like my lemonade stand, at the end of the project life. In this example, I don't have that. So this is given to you, and then the cash flow from the fixed assets is a sum. Then we have the operations piece. We just went through that. So I've got the revenue from above, I've got the expenses from above, and the only new thing here is the depreciation. So I take the cost of equipment and I depreciate it over 4 years. So 1, 2, 3, 4. Okay? I calculate pre-tax profit, just like I did over there. I calculate tax, and their tax rate is 40%. So I calculate that. Profit after tax, just like I did over there. And then what I do is I add back the amount of depreciation. And you got to remember how your formula is set up. So what you want, when you guys are looking at this, a check to see if you're doing this the right way, typically operating cash flow is going to be greater than profit after tax, because you're adding back that depreciation expense. So that gives me the 4 years of operating cash flow. Then I go to the next section, which is working capital, and I just pull that information from above. I have the 8,000, the 6,000, the 4,000, the 2,000. And then I do what we talked about, the change year over year. So if I go this year minus last year, 8,000 minus 0, that's a positive. And then 6,000 minus 8,000, that's actually decreased the working capital. So our working capital is going down. So I calculate that, and then I take that change value and I essentially multiply it times -1. And that will give me the cash flow from working capital. And then the last thing I do is I add those three values together, and that will give me the total project cash flow. Calculate the present value, then the net present value. So the NPV of this project is 0. All that work and it's no good. But that makes sense, and part of the reason why it's 0 is that the internal rate of return for this project is only 7.5%, but our discount rate is actually higher. It's 12.